I want to tell you a story today about a young boy who was destined for great things. He started his elementary school life going to the library and learning things about business and entrepreneurship and how to make money. He then used this expertise in order to start a paper route and earn some money that way, which quickly turned into door-to-door salesmanship of chewing gum, different magazines, and even things like good old Coca-Cola. Soon after that though, he had amassed enough money in order to buy a simple pinball machine that he and his friend actually put in a local barbershop. And by doing this, they were able to make enough money to buy several more pinball machines and then sell that business a couple of years down the road for $1,200. Now with that $1,200, this young boy decided to buy a farm at the tender age of 14 years old and rent it out to people who wanted to live there. He bought this for $1,200, which is about $21,000 in 2023 dollars. Back when this young boy was just 10 years old, he accompanied his father to the New York Stock Exchange and started learning more about investing and how the stock market worked. And at 11, he actually started investing his money. And he picked very specific companies that he believed in, and all the extra profit that he made from his ventures was going into those stocks. Fast forwarding a few years though, this young man had achieved a master's degree in economics from a prestigious school and had started his own investing firm. He was investing with his firm's money, which he also raised from outside investors. And then he also invested for himself as well, which later on became a single entity. Nothing that he bought in the stock market was ever sold by him, and he really utilized his natural tendencies to be able to understand complex topics like entrepreneurship and business and applied this to his investing life, along with his ability to be patient. Over time, this young man, now a grown man, became a titan and amassed masses of capital that you wouldn't believe, and of course was more than enough to live off of. And that's an understatement. The portfolio at this point had been growing for over 70 years, and it had grown to a point where it was returning $5.7 billion per year in dividend payments. If we consider the average person that needs about $50,000 to cover their costs for a year, that means that $5.7 billion that was paid in cash dividends will be able to support 114,000 people. At this point, you might have guessed it, this portfolio is no ordinary portfolio. It's a company called Berkshire Hathaway, and that young boy is the best investor of all time, Warren Buffett. And he might just be the best dividend investor that ever lived. The only thing though, he could use a new car. The notion of living off dividends is becoming more and more popular in today's economy, which is all about passive income and living off that income. And dividend investing is not a joke, and it's actually a very viable way to live off these dividends.
One of the real interesting things about being a dividend player is I don't have to choose between AT&T and Verizon, the two big dominant.
You get to buy both if you want.
I buy them both.
It's kind of synonymous with long-term investing. And once you build up a strong portfolio that has a lot of dividend stocks and it's paying a lot of dividends, much like how you can live off an investing portfolio, you can live off cash dividends as well. Today I want to walk you through what you want to look for in dividend stocks in order to choose them, how much you need to live off dividend passive income, and finally I'll talk about some caveats and things you might want to consider when having a full dividend portfolio. Let's first turn to how you might determine which dividend stocks or ETFs you want to buy. And this is probably the most important part, because when we think about dividend investing, we think about single name stocks or even ETFs, and we think of them kind of in a vacuum with their dividend yield. But in reality, we really want to diversify just as we would with a traditional capital gains type portfolio. And yeah, you heard that right, ETFs also pay dividends. Of course, this varies and some do not. But what exactly is a dividend? Essentially, it's a cash payment from a company to its shareholders that it pays out instead of reinvesting in the business in order to grow. So essentially, they're giving you their lunch money and you're the bully. So
PacWest leading the rebound after slashing its quarterly dividend. The CEO saying this: reducing the dividend was a prudent step to accelerate our plans to build capital. Our business remains fundamentally sound.
There's of course ongoing concerns about smaller companies and less established companies paying dividends, because essentially they're paying that cash out when they could be reinvesting it and growing their business. And that's typically why you see very established dividend paying companies being large, huge conglomerate corporations that don't really need to grow anymore because they're already massive, and so they will be more likely to pay dividends on a regular basis. So generally speaking, what you need to know here is that there's 3 different kinds of dividends, and of course this won't be obvious when you're looking at dividend stocks which one it is, but you can of course find this on the company financials and in their packages as well on their website. But essentially there is steady dividends, constant dividends, and residual dividends. Constant dividends are ones that are paid no matter what. If the company is doing good or bad, this dividend is paid out regardless, and you don't really have to worry. It's kind of like a secure payment. Maybe not as secure as a CD or GIC, but you get the idea here. Second is a steady dividend, and this is the case when you are paid the same dividend yield, but this is regardless of the stock price. We'll talk about dividend yield in a second, but when the stock price goes up and goes down, you're pretty much taking part in this and getting a higher or lower dividend depending on where the stock price is. Finally, there is the residual dividend, and as this sounds, it is the dividends that are paid out with cash left over when all expenses of the business and capital expenditures that the business is spending on are covered, and it's kind of the leftovers, so to speak, that is paid to you as an investor. When you think of dividend investing, you might be very obliged to look at the dividend yield, and although it's a good measure in general terms, it can be quite misleading, which we'll talk about right now. So the dividend yield, if you're wondering, is the percentage of the current stock price that is being paid out on an annual and per share basis to investors. So let's look at an example to make that a bit easier to understand. If you have a stock that is trading at $100 per share and we have a 4% dividend yield, that means that $4 or 4% of $100 is paid every single year to investors. The misleading part of this is when we get into falling stock prices. So if instead the stock were to fall to $50 per share and keep the same dividend of $4, this dividend yield would now be 8%, which is deceiving because the stock price is going down, so you might end up losing money over time, but the dividend yield is very enticing and draws in investors. So it's very important to make sure you understand how the dividend yield works and try some examples for yourself so you kind of know what you're looking at. If it seems too good to be true, it probably is, and make sure to check the chart that goes along with that stock to kind of see what the overall trends are over the last year or 5 years or 10 years. So the best way to look at it then is that the dividend yield, if it's abnormally high, say above 4 or 5%, you should be cautious, and it's probably trying to compensate for something to either draw investors in to raise more capital for the business, or it's simply just kind of on its way out. What I would advise you to do to look for good dividend stocks or ETFs is to look at the historical dividend payments of a certain company. If they've been constant in paying a dividend, since when companies do bad historically, they stop paying a dividend. So if they have a good track record of paying the dividend over and over again, and if that dividend amount is increasing over time, not the yield, but the actual dollar amount is increasing over time, these are all great signs that it's a strong and healthy company to be investing in and earning dividends on. One awesome spot to look for dividend stocks as an idea, or even to get your potential portfolio of stocks or ETFs, is called the Aristocrats list. And this is a list of very strict qualifications that track only the best dividend stocks. So first is that it needs to be a member of the S&P 500. There's also a need to have paid a dividend consistently or increased that dividend consistently over the past 25 years. So there's a huge long track record of these paying dividends, so they're very secure in their dividend payments, and typically these are very well established and larger companies. There's currently 65 on the list, so you can check it out I'll have a link down in the description. Now the important bit, well, how much do we need to actually live comfortably off of dividends? I want to start by pointing out that the average portfolio that is realistic returns between 2 to 5% per year in dividends. In terms of individual stocks, you can expect anywhere from 0.5 to 10%, but again, be wary of the risks associated with this and build a diversified dividend portfolio instead. So let's say the average person requires about $40,000 per year to survive in terms of their living costs, and this is what they would need to be financially independent based on their dividend income. So how can we calculate how much we need invested into dividend stocks to live off of this? The answer is really quite simple, and for this example, I'll use 4% as our annual dividend yield here. So if we divide that 40,000 by 4%, and this is a general rule, your living costs, what you would like to cover, divided by your average yield of your dividend portfolio. So this gives us a number of $1 million. And although this seems very large, what's really cool about dividends is that it offers flexibility. Let me explain. So if you get a dividend paid to you and you're young, you likely won't have any use in cash dividends. But what's really interesting is that you can reinvest those dividends, meaning that the broker will automatically take cash paid dividends and reinvest it into shares of that stock as fractional shares. So over time, as the dividends are paid, you're owning more and more stock, and again, that stock has time to compound.
Reinvesting that dividend is a consistent and careful and slow way to build wealth over time as you move into retirement. And then when you're in retirement, that dividend is a great thing to have, and to have that dividend grow while you're in retirement helps you keep pace with inflation.
The really cool part about this is that you can keep reinvesting dividends until you're at a point where you say, okay, I want to retire, now I want cash dividends. You flip the switch in your brokerage account and bam, you get paid cash dividends, which you will be taxed on, but the portfolio value will be so large, especially if you're adding to it regularly and reinvesting those dividends early on. You're gonna have a huge amount to be paid to you as dividends per year, which is really cool how you can just flip that. Because for a regular portfolio, you would have to sell some stock, disrupting compounding interest in order to live off of it. So this is a great way to kind of keep that nest egg growing while you take off some cash dividends and live off of that. How long would this take? If we take a $10,000 initial investment, which is pretty average, I would say, let's assume that the stocks grow at roughly 5 to 6% per year and that we have an average 4% dividend yield. Of course, the growth might not be this high, but just for this example, let's try it out. So if you plug in these numbers, it will take you 36.5 years with $10,000, adding just $200 per month to get to $1 million and to be able to live off of dividends. But what if you wanted to be a bit more aggressive? If instead you started with that $10,000 and you invested $2,000 per month, this would get you to that $1 million mark in just 16.5 years. So if you're currently 25, you'd be able to retire at 41 and be financially independent off your dividend income, which is pretty cool. These percentages for return and dividends are by no means set in stone, so it might vary a little bit. It might be closer to 20 years, might be closer to 10 years. Really depends on what happens in the markets, but as a general rule of thumb, it's very doable to retire early off of dividend income. And that being said, let's turn now to some caveats and things to look out for. It's very easy to get caught up in getting a cash payment. It's much more dopamine inducing and it's very exciting to get a cash payment every quarter. But in reality, if it's only 4% and that stock is stagnant, meaning it doesn't grow at all, you're really underperforming the market getting just 4% cash on your money instead of getting 7 to 10% investing in the market overall. This trade-off also has to do with volatility. The market goes up and down pretty crazy, as you probably have noticed in the last couple of years here. But when you're investing in the aristocrats list, for example, and you have a handful of these stocks, they're notorious for paying their dividends on time. It kind of bakes in that safety, but of course that comes at the cost of maybe forfeiting some returns. Another thing that I'd want to note as a caveat and something to look out for is that if you're not investing in your Roth IRA or TFSA here in Canada, there are definitely some tax implications that you also want to consider. First of all, the dividends that are paid out are taxed as interest income, and that means they're almost taxed the same as normal income, which is the highest investment tax rate that you can pay. So that's definitely a disadvantage. In Canada, however, there are some tax benefits and tax exemptions because Canadian companies already pay tax on the amount of dividends that are then paid out to investors, and so you get a certain amount of tax credit, which makes them actually the least taxed investment in the marketplace. But of course, capital gains only taxes 50% of your gains on an investment at your normal income tax bracket. So this is something to consider if you're considering dividends versus just normal capital gains growth. I also just want to emphasize again the dividend yield and how it can be increasing if the stock price is falling, if the company increased the dividend, or even when both occur at the same time. And this can be pretty misleading. And honestly, the dividend yield is kind of the snake's oil salesman of the investing world. So just be wary of that and always be looking for dollar figures of the dividend payment, and then know what the stock is doing over time. Don't just go blind and buy a dividend stock, check its chart first. And as always, if you have any questions, of course, leave them down below. I'm pretty quick at responding. Thanks so much for watching, and check this one out next.